Hello there, this is Dario Kerkez, Certified Financial Planner with IHT Wealth Management and author of the book of Tax Advantaged Millionaire, the 401k and 403b Blueprint. And in this chapter, I like to cover actually chapter 1 because in this chapter I covered how actually 401k plans came to be and what was happening before that and why they were invented. So just before and probably post-war, 1945, when majority of the even baby boomers came back from the war, they started having babies, they were working in factories, maybe GM, General Motors, the Fords, the Boeings, large companies and everything. They had what was called a standard defined benefit plans, meaning benefit was very defined in case they stayed there for many years and they'll receive a pension, the old school pension. You work there for 30 years, you retire, and they're going to calculate by some math formula by this number of years and this average salary, this how much you're going to get every month in case you retire at age of 65. Now, sometimes in 1979, that was actually working quite well, but the majority of responsibility for that pension plan was not really on employees, it was really on the company. The company had to segregate enough money to fund that liability, which was really the payout to the employees for their lifetime. They need to hire, the fund managers who are going to invest that money professionally. They have to find the actuaries to calculate how much and how long these people will live and how long this benefit will be paid for their lives, for their spousal lives, etc., etc. So basically, it was making things very costly and very complicated. Now, sometimes in 1979, there was a young consultant named Ted Benna, and he was hired by a bank client to basically figure it out how the upper management can receive a certain bonuses but not incur heavy taxes on it. So he was kind of shuffling through the IRS code and reading through it to see what would be a good fit. And then he found this section in the IRC, or the Internal Revenue Code, under the 401. And then it starts at A and B and C and D and there's K. And then it says that basically employees could defer a portion of their wages through payroll and in a qualified plan. So the important term here is to have a qualified plan. And then this money could be qualified to be then reduced off their gross income and reduce their income taxes. This was a revolution back in the day. And then he wanted to basically set up the plan for one of these clients that probably could not even believe him. So eventually he did set it up for his own company. And then when they implemented that, they were so successful that everybody wanted it. Everybody wanted to have a piece of the new 401k regulation that was there. So initially it was really intended for the largely compensated senior executives that had way larger income that needed to be reduced their income through the portion of the payroll deduction, and this was really the bonus payouts. Now, really, what is a qualified plan? The qualified plan is a plan that is defined by the IRS Code and Department of Labor, that in case the company sets the plan that allows employees and cannot discriminate, this has to be available to everybody, including not only the upper management, but also to the regular rank and file employees, that they can defer a portion of their income or dollar amounts to a plan and invest that. Then they can not only deduct that money off their income, but also the growth will be able to be accumulated on a tax deferred basis. And in case they later was set up as a Roth account, that in case they do that on an after-tax basis, then the money can grow tax-free for retirement. This was such a big revelation that just in about a year or so, the many larger companies were starting implementing that as a precursor of reducing the defined benefit plan and reducing the ordinary pensions back in the day and reducing the liabilities from the companies, and then starting to increase the defined contribution plans that were really taking off. But in this case, really the transfer of liability from the corporations to the employees was very successful.